What's up, guys? Welcome back to Tax Made Simple. I'm your host, Karlton Dennis, and in today's video, we're going to talk all about management companies. I've been utilizing management companies as a tool to help my clients create additional deductions, but in today's video, we're going to talk about how you can leverage a management company today. If you're somebody that's new to rental investing, you're new to business, this will be a great tool for you ongoing that you can utilize every single year, and I'm going to break it down into today's video. Without further ado, let's dive in. All right, guys, so first things first is we need to talk about what a management company is. If you're somebody that's new to business, you can do all of your operations out of your operational company. It could be a sole proprietorship, it could be an LLC, it could be an S corporation. You can go as far as to set up a C corporation. But sometimes there needs to be a separate business that manages over all of your business endeavors. When you grow and you start making money in one business, you might decide to start a second business, and that second business's profits really well, and you carry those profits on to start a third business. And then you decide you want to park some money into real estate, so you open up a real estate LLC. And now you have all these different businesses. They're all cash flowing, they're all making good money, but guess what? You're one operator, and you as one operator needs to get paid for operating all these individual businesses that you have. And guess what you can do? You can decide to establish a management company, a company that manages over all of these entities that you have, that gets paid for doing one job: managing over entities. Some of the management capacities that you may have could involve payroll, could involve marketing, could involve advertising, could involve the hiring and firing, could involve HR. It could even involve some of the corporate decisions that you have to make in order to grow and expand your ideas into the marketplace. Are you getting paid for some of those things? Well, establishing a management company allows for you to do a strategy called income shifting. And if you shift income from your operational companies, such as your real estate business that's holding your investment property, or your clothing brand business that you may have, or your physician practice that you may have, if you shift income over from those operational businesses into your management company, you have created an expense. And that expense is deductible to your operational company, but it's income to your management company. Now, we have the management company in place. It's just received income for managing over our entities. But why does it have that income there? If we're just going to pay taxes on that income, then what's the point of having the management company? Well, the second point of having the management company is to shift income to other parties that have lower tax brackets than you do. This could be a spouse who may not have returned to the job force yet. This could be children who are helping you out in your business. And the reason why this is so important is because many taxpayers want to be able to incorporate family members into business without drawing too much additional tax all around. By having a properly structured management company, we can create an expense at the operational level by paying the management company, and then we can create a second expense by dispersing the management company's assets, the cash that it has, to our children or our spouses. Now, I have placed a lot of spouses on payroll, sometimes through the operational company, but also sometimes through the management company. And here's the reason why. If you're investing into rental real estate, the IRS does have a rule called the real estate professional status that can allow for you to turn your rental properties from a passive activity into an active activity. What this allows for the taxpayer to do is to capitalize on big depreciation deductions that could thus offset the W-2 or 1099 flow through LLC or S corporation income that you may have as taxpayers who are filing a joint tax return. If you're filing a joint tax return and your spouse has not returned to the job force yet or is unemployed, you can give your spouse an employed job as being the manager over the real estate portfolio. By establishing a management company, not only are you showing the IRS the intent to manage over your investment properties, you now have a dedicated business with a dedicated EIN number and business bank account to run your management transactions out of. We have tons of spouses who have set up their management companies, and these management companies manage over the real estate portfolio, allowing for the spouse to garner hours in material participation to make the real estate an active business. By performing the cost segregation study shortly after, we can accelerate depreciation, create a loss on the tax returns that's an active loss, and we can offset active forms of W-2 and 1099 income. Now, Because we have that real estate management company in place, the spouse can draw a salary for managing over the investment properties. So if the investment properties are sitting inside of LLC holding companies, the management company can bill those LLC holding companies a management fee. And that spouse who is managing over the investment properties just got paid a management fee, which is a deduction for those LLCs holding the property. It's income to him or her, but then they could turn around and disperse that out to their children for managing over that property, or in return, pay off some of the expenses that they have associated with managing that property, so they're not subject to a taxable event when that income comes into the management company. Let me go over some of those management expenses that you might have for managing your investment properties. This could include auto and vehicle deductions. This can include your home office deductions. This can include meals when you're eating out in the capacity of a manager over your real estate operation. This could include travel, lodging, as well as airfare. For any time that you need to travel to your properties, you need to stay relatively close to your property. This is so needed for many business owners that are trying to live the lifestyle of being a real estate investor, but also turning more of their lifestyle into a tax write-off because they're an investor. If you have a real estate management company, that management company should be the business that you're taking your management expenses out of. If you're flying to your property to go see it, if you're going to go make repairs to your property, those expenses that you have for flying and traveling to your property should come out of your management company. If you have expenses associated with your rental, the expenses paid by your rental should be paid out of your rental LLC holding company, right? So this is why we look at the management company and the rental holding company as two very important vehicles for the real estate investor to have. Now, placing children on payroll. This one comes up all the time. In the year of 2024, the standard deduction is $14,600. You legally can pay children up to the standard deduction without children needing to file the tax return and pay tax on the amount of income that they've received. By having an LLC management company, you can avoid having to issue out a formal W-2 to your child while simultaneously still being able to pay them up to the standard deduction of $14,600 in order to receive a tax deduction in the year. But what about your home? Couldn't you take a home office? If you're managing your rental properties from the convenience of your home, this is when we can exploit the home office deduction as well. Most landlords are running their operations from the convenience of their home, and the IRS knows this and allows for you to take a home office deduction, which could help you offset some of that management income that you pulled over from your real estate holding companies. What if you decide to get into your vehicle and you're going to drive to your properties? Can you decide how much is business use versus personal use? Absolutely. Does the IRS allow for you to write off your vehicle business use wise if the business use is more than 50%? Absolutely. But if it's less than 50%, this is when you cannot deduct the vehicle. So if I'm a landlord and I have a rental management company, I'm going to try to have a rental management vehicle if my rental management operation allows for me to be able to drive to and from the property. If I can drive to and from the property, I can determine how many days out of the month, how many days out of the week that are business purpose relative to how many days out of the week that I'm using that same vehicle for personal purposes. Once I get that percentage, as long as it's over 50%, anything in excess of 50% is deductible on my tax returns for business purpose. And that is how you're able to claim the vehicle underneath a management company. Whether you bought the vehicle under the management company or it's in your personal name, the IRS still allows for you to write it off. And this is another benefit that you have because you've decided to set up the proper management company. Now, family management companies, rental management companies, off-year C Corp management companies, those are the three types of management companies that I work with. The most being the rental management company, because the majority of my clients will buy real estate to create depreciation losses. But I also work with companies that have fiscal year-end C Corps that don't file tax returns on the same year as S corporations, that operate as management companies as well, or operate as separate marketing companies as well. Taxpayers have been able to shift income from their high tax rates of their S Corps, 37%, into these C corporations that are on a different fiscal year end that are being taxed at 21%. A management expense is being paid from that S Corp to that C Corp in order for that to be a deduction. That being said, if you're watching this video right now, any of the strategies that I'm covering require you to have a licensed tax professional, someone who has done these strategies before in the past and can show you the court cases on each one of these strategies before they make the recommendation for you to decide to implement it. My name is Karlton Dennis. I'm trying to make taxes as simple as possible. Today we covered management companies, and I know it wasn't easy, but you got through the video and I'm proud of you. Guess what we're gonna do? We're gonna continue to stick on this channel, learn more tax knowledge. You're gonna get smarter by being here. I'm gonna make sure I keep putting out videos for you, and we're both gonna get wealthier at the same time. I love this, and I love this channel, and I love that you decided to subscribe to it. I'm gonna continue to put out more videos for you. Go ahead and like and share this video. Let me know your thoughts in the comments below, and I'll see you on the next one. Cheers.